Reserve is expected to raise interest rates several times in 2022. This is Fed Chairman Jerome Powell on what will be needed to ensure a long economic expansion.
That's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal.
The way the central bank does this is by changing the federal funds rate, its main tool for managing the economy. You can see on this chart that the rate was lowered to nearly 0% in 2020 to boost the economy at the beginning of the pandemic.
There is an important job for us to move away from these very highly stimulative monetary policy settings.
Adjustments to the federal funds rate influence a range of borrowing costs, from how much you owe on your credit card to mortgage rates. They also shape broader decisions made by companies, like how many people to hire or whether to raise prices. Here's how the federal funds rate works, and how just one rate can guide the entire economy.
The Fed meets every 6 or so weeks, and they're looking at a range of economic data at those meetings. But they have two main goals. One is to ensure stable prices and low inflation, and the other is to make sure that the labor market is strong.
Nick Timmeros covers how the Fed guides the economy through crises. He says you can think of the economy as a car and the Fed as the driver.
They want to make sure that the economy is not growing too slow, and when it is, they'll push on the gas, but they also want to make sure that it's not going too fast, and so they'll slow the economy down by pressing on the brake.
This is where the federal funds rate comes in.
When you hear on the news about the Fed raising interest rates or cutting interest rates, what they're actually deciding to do is to raise or to lower the federal funds rate.
This is the interest rate that banks charge each other to borrow money overnight. But there's a catch. The federal funds rate isn't directly set by the Federal Reserve. So in order to influence it, the Fed uses a couple of other tools to set a target range. These tools are rates that the Fed controls in its role as a bank for banks. Here's the target range that was in place during 2021. The Federal Reserve sets an upper limit and a lower limit, with the goal of keeping the effective federal funds rate somewhere in between. The upper limit is determined by interest on reserve balances. This is the rate of interest a bank gets on deposits, known as reserves, that it keeps at the Federal Reserve. The lower limit is determined by overnight reverse repurchases. These are securities, like Treasury bills, that the Federal Reserve lends to banks, usually for a day, while paying interest. On this chart, you can see where the Fed has set the target range between the two yellow lines. The blue line, which is the effective federal funds rate set by banks, sits between the upper and lower limits. As the target range changes, the effective rate goes up or down with it.
So far, they've had very successful control over guiding the federal funds rate and guiding all short-term money market rates to where they generally are trying to move them.
The Fed makes these adjustments in fairly small increments. Its rate increases for 2022 are expected to only change by about 1/4 to 1/2 of a point at a time. So how can these tiny adjustments for banks help cool down the entire economy? It all has to do with how those rates ripple through the system. As banks are charged more to borrow, they'll in turn charge their customers more, affecting the cost of existing loans and demand for new borrowing. The goal of raising these rates is to drive down demand.
Inflation results when supply and demand are out of whack. The Fed can't do anything to increase the supply of oil or to increase the number of houses for sale. The supply side is something out of their reach. But they can bring supply into balance by reducing demand.
Here's how interest rates can influence demand and inflation. When rates are low, more people and businesses are likely to take out loans. Higher demand for goods and services, as well as lower rates, allows employers to open more positions to meet demand and raise wages to appeal to potential employees. Consumers then turn around and spend those wages on goods and services, which in turn can lead to more jobs and higher prices. The opposite happens when rates are higher. Fewer people and businesses take out loans, job growth slows, and spending decreases. Higher interest rates may also make it more appealing to save. Inflation slows as supply and demand balance out. While interest rates can be effective in bringing inflation down, a rate hike could take some time to make an impact.
Think about your own life as you go through making different decisions about whether to buy a house and how big of a house to buy. It may take a while for this to ripple through the housing market, for example, but in 6 or 12 months, we could begin to see less demand if interest rates are high enough to slow interested consumers.
But while inflation may take time to come down, consumers and businesses will likely feel the impact of higher interest rates on loans, mortgages, and credit cards right away.
Hi, this is Kaden from VIA Value Investing Academy. Now, thanks for joining another evening session of our deep dive series. But before we start, I would like to give credits to the production of this video, right, which is by Wall Street Journal. Yep. So just now you have heard some explanation about this, managing the interest rate, right, to tame the inflation. But just come back to my slides over here. I'm going to show you another slide. I'll just let my teammate put out my slide so that you can see another video, right? Now, on the slide over here, you should be able to see a video in which the production is done by economists. But I'm not going to play it. I'm just going to show you there's another video as a reference. And the title of this video is How Does Raising Interest Rate, right, Control Inflation by Economists? I think the video is 9th of June. Look at it, 1.1 million views. Wow, that's my dream for our YouTube channel. What's about 1.1 million views? Now, but anyway, if you're not an economist or your background is not a business like me, right, you may find it very difficult to understand what they're saying. But what does it mean to us, right? Since we are VIA Value Investing Academy, we are trying to connect the dots between interest rates, inflation, and our investment. Okay, so let's get started. But before that, can I just double check? Are you able to hear me and see my slide? If you're able to hear me and see my slide, is it okay? Just type 1, right? 1 inside the chat so that I can see. Now, while you're typing, this evening, there's lesser audience, right? There's about 70 plus. Usually, there's about 150. So I guess tomorrow is Friday, though. So everybody prepare. By the way, what happened? People, but it's okay, it's okay. The show must go on, right? So let me just share with you some of the exciting things that we're going to talk about tonight. So the first thing is, of course, I'm going to talk about interest rates. Interest rate. I just want to share with you 20 years ago, if you tell me interest rate, all this, actually I have no idea what is it. I mean, what does it matter, right? Yeah, so interest rate. So I'm going to talk about this. This is a bit of a recap, right? And since we are all about investment, we're going to talk about how interest rate actually affects our investment. Yeah, our companies, our stocks. Then after that, right, we'll talk about some of the recession-proof sectors. This is a recap, right? Then after that, we're going to talk about a recession-proof industry because in total there are 11 sectors, and each sector there are many industry, right? So today we are going only to focus on a sector, right, called consumer discretionary. Then within this consumer discretionary, there are many industries. Then we will focus on one industry, which is quite exciting because it has to do with the internet. Very good. A few people responded, right? So the Raj should be watching this from Switzerland, right? Yeah, the Raj, are you watching this from Switzerland? Yeah. What time is it over there? Right now here it's about 7:30. What time is it over there? How's the weather over there? So I'll let you take some time to type, right? Yeah. Now, these are a recap again. If you have been following our deep dive series, I would have shown this diagram maybe a million times. But this is summary, right? For the past many sessions of deep dive, I've been talking about some of the quantitative factors and some of the qualitative factors that will affect the economy and overall may trigger off a recession. Yeah, recession. And usually the recession will only take place after a bear market. But the bear market is already here. Yeah. So recap. When we say bear market, that means if we use S&P 500 index as a gauge from the recent high, it drops until today, right? Today, if it's bigger or equals to 20% or more, right, in terms of the decline, then it's a bear market. So in other words, the bear is already here, bull is still not here. So the bear is still hanging around. And whether after a bear market, would there be a recession? Nobody knows. Yeah. But if you look at what the Fed is trying to do, US, right, they are trying to play with the interest rate so that there will not be any recession. I don't think anyone wants a recession except me. Yeah, because I want to buy stocks. Wow, Diraj, 1:39 a.m. I suppose. p.m. Okay. Oh, thanks. Thanks for watching this, right? Okay. So let's do a quick recap about what's inflation. I think everybody knows inflation usually we refer to the increase of the prices of goods. And I think I'm age 51 this year, right? I think for the past 51 years, this period is the one that I really felt the inflation. Usually the inflation is so small, I don't really feel it. Well, but this time around, I really feel it. Yeah, especially the noodles, the kopi, and all this. Wow, I think the price suddenly shoot up. Oh, I think I really feel it. But usually the inflation, we are always referring to the high side, but there's always two sides. So in total, right, there are two sides to inflation. So one is called low inflation, in which usually most people don't talk about it. So when we say low inflation, that means the demand, right, for goods and services are lower. So if the demand is lower, people will delay purchase, right? So if people don't want to buy, businesses will not do well, economic growth will slow down, and then, oh no, our business is not doing well. So it's impossible for you to increase the wages, right? So wages will be depressed. Then this is the trigger, right, for the infamous global financial crisis in 2008-2009, and of course, resulting in unemployment. Yeah, but of course, 2008-2009 has been 14 years, and most of us have forgotten already, right? Yeah, this one. And then, of course, the high inflation is what we know today. We would have felt it. Things become more expensive, and then, okay, too expensive, don't buy. Don't buy again, slow down. So you realize that high, it trigger off a low purchase. Lower also trigger a low purchase. So the end point is the same. Both will end up with unemployment, which is quite bad. Yeah. So I think from a very high level, if you're managing a nation, I don't think anyone wants a recession. So in other words, somebody need to manage what is high and what is low, right? So I just want to let you know that the optimal interest rate, is around 2% or slightly lower. Now, bear in mind that the context I'm talking tonight is the US. And US is because I'm very interested in the US companies. And usually when US is the largest economy in terms of GDP, right? So now something happened to US, the world will be affected. Yeah. So that's why I'm very fascinated with the US. Okay, so Dheeraj, 1:39 p.m. Okay, very good. So while you're working, you're watching this. Okay, let's come back here, right? So remember, high is bad, low is bad, optimum is 2. Yeah. So now somebody need to play with this, right? And just now the video say, oh, it's like car, right? Too fast is bad, too slow is bad. So somebody need to play, this interest rate at certain optimal, which is 2% or below, right? But as of now, it's not low. As of now, it's high. So how high, right? 9.1%. Now 9.1%, if you wrap it up, it's very close to 10, Yeah. So this is really high. Yeah, really high, right? Yeah. The highest since November 1981. Yeah. And then previously it's only 8.6 and 8.8. So this is really bad. This is really bad, right? So somebody need to come in and intervene. So the party that tries to adjust the car speed is this organization called Federal Reserve System, sometimes a Fed, right? FED for short. And the key person who is the chairperson is this Jerome Powell. Just now you saw the video, right? So it's this fella, right? So this fella need to adjust the car, right? Yeah, interest rate, Now, so in other words, he has to play with the interest rate, right, to tame the so-called the overhyped economy. And if you look at some of the news articles right now, we will have read companies such as like crypto lenders, right, going bankrupt and so on. I think the one that I read recently is called Celsius. Celsius. Yeah, Celsius. So the founder of this Celsius, I can't remember what his name, but he wears a T-shirt. He wears a T-shirt, and then the words go something like, don't trust the bank. Yeah, don't trust the bank. Yeah, he's trying to say that don't trust the bank, trust me. So people put billions inside his company, and the company gone. Okay, So in other words, remember, the party that's managing this interest rate, controlling the speed of the vehicle, is the Fed. So how does it work, right? Remember, the economy right now is overheated, as reflected by the high inflation rate, which is 9.1%. So somebody comes in, which is the Fed, right? They increase the interest rate. And recently, I think by 0.75%. So once they increase the interest rate, what does it mean? To put it very simply, right? If the interest rate goes up, and if let's say you want to buy HDB and you want to borrow, right? And because the interest rate go up, you want to borrow more expensive, more expensive. And which also means that for businesses, especially MNCs, it's quite common that they have debt. Yeah. So that the interest on the loans they borrow will have shot up. Okay, So businesses or individuals will spend more on interest, right? So because so expensive, I need to spend more interest. Maybe I should control my spending. So if I lower my spending, I got a cash, right? So where should I put this cash? since I really lower my spending and then I've got some cash, since the interest rate go up, must as well, instead of borrowing to pay the interest, must as well I deposit to collect the interest. So you can see now the human behavior change, right? Human behavior change. So if that's the case, if I'm putting in the bank and then lesser money circulated, of course, the inflation slowly will drop because lesser and lesser people buy things. And then this in turn, right, will so-called tame the overheated economy. So this is what the Federal Reserve is trying to do. This is a quick recap. If you want, you can do a screenshot of this. Then, of course, ultimately, interest rate go up. How does it affect the stock market as a whole? Now, remember, Fed increased the interest rate. Yeah, businesses that we are investing, especially traders, never catch a falling knife. So the moment they see the share price drop, it's like a knife dropping. Wow, so they don't want to catch. What do they do? They do this thing called cut loss, right? Yeah, cut loss. So they sell stocks. And of course, one person sells stock, 10 people sell stock. It becomes a network effect. So more and more people rush to sell stocks, which is why, right, the S&P 500 collapsed by 20% or more. Bear market. So if they sell stocks, they got cash, and then they worry that they lose money in the stock market, where would they put their money? They will shift their money into fixed income instruments, such as bonds, which is why I think the most recent batch of Singapore saving bonds was oversubscribed. Yeah, so this is how interest rate affects stocks. Right? But I just share with you quickly my perspective. My perspective is, number one, don't predict interest rate because nobody can ever guess. So don't bother. The second thing is interest rate will not stay this high forever. Somewhere down the line, the interest rate has to go back to the optimum, which is 2%. Which also means that if the share price drop right now, and then you have identified some companies which are very good company, they're so-called recession-proof, and this inflation-proof, right? And then share price drop. Actually, it gives us a lot of opportunities to buy stocks right now. Okay, but provided you know exactly what to do. So this is a very important diagram, and right now the high inflation already triggered off the bear market, but we already know in our previous deep dive episode that every bear market will always be followed by a bull because bear market do not last forever, and that includes bull. So which means that at this point, right, it's really a good time for us to invest in the stock. Later on after the break, I'll share with you one company that I already purchased, and just now, right, when I look through the numbers, make me feel more excited. But I'll share with you later on, right? It's actually a home builder. It's an American home builder, right? So let's come back here. So of course, with the high inflation rate, the bear market, and then the possible recession, the question is, are we prepared for this? Sometimes we have this, people always talk about this phrase called saving for a rainy day. So it's something along the line, right? So when we say prepared, that means we must know exactly what to do. Because if not, right, everyday recession is no use. Then the second thing is, if you want to do something, of course, you need to have cash to do something. So you need to have these two things. And the reason why we are doing all these deep dive series, by the way, just to let you know that it takes up a lot of time. Especially from Hillary. Hillary take days to just prepare like a 1 hour presentation. It's a lot of work. And we spend a lot of time doing this is because number one, this is live. Also, we don't want to screw up the information live, right? So that's one. And then social media right now is quite pervasive. So when we say something, it's like cannot take back already. Once you say it out, cannot take back. So it's going to be on YouTube. So I think we better make sure that our information is solid. Solid, right? Okay. So just to let you know, this is something we are quite proud of. Quite proud of. The reason why is we have been talking about the bear market recession for months. So before bear market, we said that most likely there will be a bear market, so it came. But remember, we are just using some economic indicators to point us to one direction. So bear market check. And then as we look at how the world is moving, most likely US is going to be a recession. But of course, there's always two sides. Everybody is trying to have their own opinion, and Fed is trying to fight against recession. So let's see. So whether recession or no recession, I think we better prepare, right? So you may notice that in our YouTube channel, which is youtube.com/Value Investing Academy, right, managed by our team, Susie and Irfan, we include really some of the best work. Okay, so they own self clap own self. So then of course the content is provided by Hillary. She has to do all this work, and then Tyson Food, she has to check with me whether can we talk about chickens, and so on. Since chicken never come from Malaysia, all those things. So I mean, I don't like to do administrative work, but discussing all this is quite interesting. So we talk about Tyson Food, right? If you want, you can click on this video over here. You can see quite detailed, right? And then after that, we talk about Silgan. So you may notice that companies like this are pretty unheard of. So if you watch those influencers, right, you talk about what, Tencent, Alibaba. I mean, people have heard it already, but have you heard before Silgan? Don't have, right? Don't have, huh? Okay, interesting. We all talk about something people never heard of, huh? Okay, huh? Then, of course, we wanted to take a few steps back and then look at the entire economy, especially the different sectors, Just to let you know that value investing is a bottom-up approach, not a top-down, right? But laymen usually ask, hey, which sector to invest? So to answer that question, I think we better do some homework. Yeah. So on this video, which is about 2 weeks ago, we broadly talk about the 11 sectors, and which are the sectors. There are only like 3 sectors. They are so-called recession-proof in terms of their performance, right, during bad days. Yeah. So we talk about this in general. Then after that, we specifically talk about IT sector. And within the IT sector, which is one of the 11 sectors, there are many industries. So we talk about the semiconductor industry. And then previously, Hilary talked about the different parts, right, about producing the chip from the design, right, just the design, all the way until the tiny little chip that goes inside a PC. And here we're just talking about a few companies in the semiconductor industry within the IT sector. So there are many things to talk about. So today, right, we're going to talk about consumer discretionary. Now, if you look at this, it sounds quite cheap, right? What do I mean by discretionary? This consumer is like us, consumer, right? So we're going to talk about a sector, right? It's like a B2C, a business to consumer type of business, rather than a B2B, business to business. Now, so and the reason why I want to show you all these videos, so in case you're watching our YouTube live for the first time, these are some of the references. And of course, the most important thing, right, is this is our YouTube channel, and the most important thing is this QR code. QR code, right? Very important. So right now, I'm going to give you like 5 hours to scan and then become a subscriber. Now, if you look at the number of subscribers, 6.5K subscribers, wow, we are really struggling quite hard. But before 6.5K, we were once 2.5K. Yeah, so I think in less than a year, we have sort of like doubled, like 2.5 times. I think it's quite good. Credit given to the team, right? Okay, so I'm going to leave this QR code here. Now, so what's the benefit of scanning this QR code? So when you scan, a message will pop out. You click subscribe, so that every time when we got hot tip, right, or something want to share with you, you will be the first person to be notified. Yeah. So right now everything has to be automated, Yeah. So that you can be self-informed and notified through the YouTube. Okay. So the QR code is here. Just scan, right? Okay, good. So let's get started, right? So interest rate, how does it affect your stocks? Done, right? So let's look at the recession-proof sector, since we are trying to explain to you from top-down approach, even though value investing is bottom-up, right? Now, before we talk about the recap, this is a disclaimer, A disclaimer, right? Yeah, I don't want to read all this, but remember, neither My Kinesis Investment Primary Limited nor VIA, right, nor the authors, which is me and Hilary, of this evening session, right, are operated or affiliated with any dealer, broker, or licensed financial advisor. So in other words, we are not licensed by MAS to say, hey, please buy this, please suggest this, please recommend that. We are not, Yeah. But as an educational company, I think it's important for us to educate ourselves. Then if you need any help, you can always approach some licensed advisor, right, from a bank or any financial institution. Okay, so let's get started. This is again recap, right? So this is called S&P 500. S&P 500. Now, S&P 500 is an index, is a basket of stocks that consists of 500 companies. 500 companies. In other words, if I have a container over here, right, this container, right, inside this container, there will be 500 companies. Yeah, out of the entire US stock exchange, about maybe 3,000 plus 4,000. Yeah, so this S&P 500 is usually used as a representative of the entire US stock market. Yeah, so imagine that right now I have a cup inside the 500 companies, and if I take the share price of each of these companies and then average it out, yeah, then I give a name. The name is called an index. Yeah, which means that if the index go up, it's a bull market. If the index come down, right, it is a bear market. Now, bearing in mind that with this number 500, there are 500 companies. 500 companies. So imagine this whole circle, right, represent 500 companies. And then this whole circle, like a cake, right, it can be cut into different slices. But the ratio of each slice are different. So, for example, if you look at the entire S&P 500, there are 11 slices or 11 sectors. So 1 all the way to the 11. And the one that takes up quite a huge chunk, almost a quarter, is actually IT, which is why previously we talked about IT. Because IT sounds quite sexy, as though the share price can go to the moon, right? That's why we talk about IT. But this time around, I think we better be down to earth, right? Down to earth. We're going to talk about another one called consumer discretionary. Yeah. But of course, you may be asked, why don't I do like utilities, energy? Since right now it's Russia invading Ukraine, and then energy is a topic. There is a reason why, right? But before that, let's see like a Venn diagram. Now S&P 500, remember, like a cup, right? Huge S&P 500. Okay, Then within this S&P 500, if I can draw a bigger circle, right? S&P 500, there are 11. So there are 11 sectors. 11 sectors. Then within each sector, right, there are many industries. Okay? So the Venn diagram will look something like this. S&P 500. Sector inside and then industry inside. Yeah. So if I can give an example, right, of a consumer discretionary sector. Remember there are 11 sectors. One of them, right, is consumer discretionary. And you realize that consumer discretionary, there are 11 industries. There are so many. Yeah, so in other words, if VIA is going to cover all these industries, I think we will cover until next year. Cover until from bear market to the bull market. Yeah, so I think we have to be very selective. So I think maybe about a week ago, me and Hillary was looking through all this. Yeah, we're thinking, what to talk about, right? Yeah, so I think the first thing, Hillary was showing me, I think it's hotel, right? Yeah, I see a hotel. Then I was thinking hotel, Scully, and if we use hotel, we are giving an impression like hotel is recession-proof, but if you look at the past 2 years, I think they are they're suffering. So we better not. Then the second one, I was thinking maybe you talk about household durable. Wow, but this one maybe not so exciting. Yeah, not so exciting. Then I was thinking which one. So in the end, we end up with this. We end up maybe a bit of like online, right? A bit of on-site brick and mortar. Yeah, but by the way, as I continue, for the audience, there are about 100 people, right? Oh, the remaining 50 just joined. They just finished dinner, last minute just joined. Now, for the remaining 50, by the way, can you just take a quick glance at this 11 industry, right? If you're interested in one industry, yeah, I give you 5 seconds. Can you just type one of them that you're interested right there, so that we can work on it the next time? So we go by like democracy, right? So can you look through this? Type the industry that you're interested. Can you just type it in the chat? One person can only type one. Type one, right? Okay, I give you 5 seconds to type, and then I'll just continue. Choose one that you felt maybe let's let Caden and Hillary do some work. Okay, so just type one. Then we choose the one with the highest vote. Okay, so I just carry on. Yeah. So of course, just now we talk about consumer discretionary sector, internet and direct marketing, retail, industry. So why S&P 500? Why S&P 500? Why Caden don't look at Dow Jones Industrial Average or any other index, right? And the reason why we talk about S&P 500 is partly because Buffett talked about it. Yeah, Buffett always recommend people to buy a low-cost S&P 500 index fund, right? That's why I think better stand on Buffett's side. Shouldn't be wrong, right? So S&P 500, but of course factually, if you look at the history in terms of the performance, right? S&P 500 has given an annualized return of 10.5% per year with dividend reinvested. And the data here, right, is dated since 1965 until 2021. Yeah, 2021. 10%, not bad. Yeah, I don't think you can walk into a bank, and I don't think any relationship manager is able to, promote a product to you, right, that can beat S&P 500. So I don't think so, which is why Buffett recommended this. But of course, to give you more meat, right, evidence that Buffett did say this, I will ask my colleague Irfan, right, to play a video. I think until 1 point something minute. Yeah, okay, so let's hear from Warren Buffett directly.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century, and then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
Wow, special thanks to Warren Buffett. I think what he say means a lot. Huh? So right now you hear from the horse mouth that, why he thinks that investing S&P 500, a low-cost S&P 500 index is important. But one thing that's more important in his speech, he shared that in order for you to buy this low-cost S&P 500 index fund, you must go through thick and thin. And he specifically said you must go through the thin. Thin, that means the bad times, which is now. Now, why is that so, right? Now, let me share with you. It's like marrying someone, a relationship. We're going to go through good times and bad times. So you can see the S&P 500 is like having a relationship. So there are good times when things goes up, and a thick, right? And there's a thin where it comes down, right? So in this case, you may notice that somewhere, right, in 2001 when the dot-com bubble burst, it drops by almost 50%, and everything, right, follows by a thick. Every bear market follows by a bull market. So you may also observe that every 50% drop is always accompanied by 100% increase, as long as it breaks even. But most interesting thing is usually the bull run will run higher than the previous bear market. Yeah, let me share with you proof. So this is the reason why Buffett said we better go through thick and thin. Now this is another one, which is the global financial crisis. Everybody will know 50% drop. But as of this afternoon, right, the rise has been 488%. It's almost 500%. So every 50% drop here, as of global financial crisis, we have almost close to 500%. Yeah. So at this point, maybe let's do a mid-check summary. So it's very important that when a bear market comes, in which is already here, plus if there's a recession in the future, it's the best time for us to invest. Yeah. So one more time, most people will run away, right? Yeah. Most people will sell, right? That's when you buy. Yeah. So this is the concept. But to buy, easier said than done, because right now it's like academic exercise. Yeah, buy. Like very easy. Everybody's selling and then you're buying. But to really act on it and press buy, right? Yeah. This action of pressing buy has to hinge on a certain conviction. And a certain conviction has to be based on facts. So in this case, factually, you see, every bear market is always followed by a bull. And of course, the most recent recession or bear market is really short-lived, which is on 20th March 2020 when the pandemic came, right? But as of this afternoon, you see 75%. Yeah, so if you don't buy when it's lower, you will never have a chance to buy when you never have a chance to sell when it's high. So it's very important, right? Now, so let's come back to here, Yeah, just now was just to tell you that whenever there's a bear market, you always be followed by a bull. And since the entire S&P 500 consists of 11 sectors, which is listed over here, right? And then previously, we already checked off the IT, right? Now, we talk about IT because overall it's about 16%. 16%. S&P 500 is about 10. So we want to find a sector that beats this. Beats this, right? So today, we're going to talk about consumer discretionary, second best. So this is the first best. We can always come back to IT another time. So second best, right? So of course, if the overall consumer discretionary index beats 10%, there must be something inside this consumer discretionary index that outperform this S&P 500 index, which is what we're trying to explore. So from the top, we're trying to filter, and then end up with a few. So just to let you know that these are some of the big companies, within the consumer discretionary sector. Okay, which also means that if you buy one stock, right, you buy one consumer discretionary ETF, such as the XLY, right? Yeah, you're buying all these companies, Amazon, Tesla, McDonald's and all this. Yeah, so if you go through thick and thin with them, in the long run, we should do well. Yeah, in the long run, we should do well, Yeah, but we're going to even be more zoom in, because here we're just talking about some of the 10 companies in consumer discretionary sector. So right now, we're going to zoom in, into one industry within this consumer discretionary sector. And this industry is called Internet. Sounds exciting, Internet and direct marketing retail industry. Okay, by the way, this is not really MLM. So Internet and direct market retail industry. So for the details, right, I'm going to hand over Hillary, and then Hillary will zoom into this industry. Yay! Let's welcome Hillary.
Hi, good evening, everyone. So I'm Hillary. So I'm here to explore about this internet and direct marketing retail industry. So first off, we will explore what is it really about consumer discretionary sector. Earlier on, Kaden has shared about it, but what is it really? So what's the difference between this and consumer staples? So first off, consumer discretionary are actually companies that manufacture non-essential goods and services. So what are non-essential goods and services? So here is the list. So from here, you can see that these are actually what we want rather than what we need. So the difference between a consumer discretionary is what we want, but a consumer staples is what we need to survive. So here actually says that this is considered a discretionary expenses, means that we wanted to have a newer phone because for example, a phone, an Android phone that might be 100 or 200 compared to an iPhone, both are phones. But iPhone could be a luxury or an indulgence compared to a normal Android phone. But both works the same. So this is what it means as a consumer discretionary. However, something need to take note. The demand for these products are actually good when the economy is rising or it's booming. But when there's a recession, a bear market, the economy is not doing well, people will tend to stop spending on these discretionary expenses in order to save up some money to buy the things that they need. Okay, so here actually shows the past decade result compared between the consumer discretionary sector and also the S&P 500. So earlier, we see that since 2013, the consumer discretionary sector has performed better than S&P 500. However, when the pandemic strikes, everyone cuts down their discretionary expenses. So you can see that there's a very sharp fall in the discretionary sector. But then there was this stimulus package and people are getting help from the government, and then they can spend some money on here, and you can see that it actually increases quite fast. But then recently we know that the economy is starting not to do well, there's inflation, bear market, and also maybe a recession. So it drops rather sharply. So we can see that actually when it's good, but when the economy is bad, then it shows here. So if that's the case, is it really recession-proof? From here, we will further explore more. Okay, it's because why we choose this sector is because we see that since the annual average returns of this sector beats the S&P 500, we are curious that how did it actually perform. So that's why we pick this topic and see what we can further investigate on. So from all these 11 sectors, actually we were quite scratching our head which one to choose from. Initially, I was thinking about hotel, restaurant, and leisure was because since the economy is opening, people might be interested to find out what is this about. But then Kaden shared with me, this does not look really recession-proof. It's because earlier on, people says that whenever we want to open a business, it's good to do something related to food, like restaurants, hawker center. However, during the COVID pandemic, this actually shows that this is not really recession-proof because when the government orders the restaurant to shut down or they cannot have people going to dine in, their businesses are severely affected. So this one is kind of pondering, maybe this is not really a good industry to investigate at the moment. So we go to the numbers and we choose this is because when we go through the numbers to check on the past 10 years performance, among all of the 11 industries, actually this industry performed much better compared to the other 10. So the next industry that actually performed better than S&P 500 is actually specialty retail, but this one performed much better than all the other 10 industries. So this perked up our interest why is this performing so well for the past 10 years? So this is the reason why we decided to investigate into these industries. Okay, so what is internet and direct marketing retail? So it's very straightforward is the company that provide all the retail services, like they sell goods and services over the internet via e-commerce, online marketplaces, or maybe currently the new term called omni-channels. So what is this really about? In our later slides, we will further find out more what this is really all about. Okay, so now we will look at the past performance of this industry. So I took one of the ETF that tracks the online retail, which is iBuy. So the reason why I choose iBuy is because it's one of the oldest and also the largest pure play e-commerce ETF. So only the companies that generate more than 70% of the revenue is included in this ETF. And we compared it against the S&P 500, which is VOO, the Consumer Discretionary Sector ETF, XLY, and also I put in another ETF which tracks the retail. So here the retail could be online and also could be offline. So we see that the blue line, which is the online retail ETF, it performs really fast in 2020 during the pandemic. It's because everyone is purchasing things online and everyone is going online to buy things. However, since 2021, it has been going slowly downwards because the economy is slowly opening up. And in 2022, it actually drops further down and even performs below the S&P 500, which is the yellow line. So when we were looking this, we were like thinking, did we choose the wrong industry? It does not look recession-proof to me. So how are we going to like turn this around? So we can see that the chart here. So it's like, okay, never mind. We'll just go on further. Then we further look into the other online retail ETFs. So here I find out there's 3 of them: iBuy and ONLN, RTH, compared against the S&P 500. So iBuy, earlier on, we have shared that it actually comprises of companies that generate more than 70% of the revenue from their online sales, online channels. And actually, every firm within this ETF is equally weighted. That means they have equal shares within the ETF. And some of the examples are like Chewy, Etsy, Booking.com. So you can see that these are actually companies that have businesses online. And then the next one, ONLN, they are quite similar to iBuy. That means they only tracks companies that generate revenue, 70% of the revenue more in their online channels. And they are much more heavier weighted to bigger e-commerce firms such as Amazon, Alibaba, and also eBay. So it's some of the names that we are more familiar with for this ETF. And the last one, RTH. So for this one, when I was looking through the companies within this ETF, they are actually companies that has brick and mortar retail. So it's kind of a combination between physical presence and also an online presence, which is a new term called omni-channel operations. So the companies that are within this ETF are known as Walmart, Target, and also Home Depot. And when we look through the chart, we see that actually this RTH is actually performing better than S&P 500 compared to the other 2. Even though iBuy at the start of 2020, it increased faster than S&P 500, but currently it's performing slightly lower than the S&P 500. And online, it's ONLN is like not here, not there, even though it performed slightly better during the pandemic, but now it's not performing as good as the S&P 500. So with that, we think that there's something interesting about this RTH. So we are looking through the company holdings within these 3 ETFs. So first off, iBuy and online, the similar presence is that they track mainly about companies that are mostly online type, or they generate their revenue from their online channels. And then we see that actually the weight between them is, one is equally weighted, but one is heavily skewed towards Amazon. So you can see that Amazon almost took up a quarter of the ETF in ONLN. But for iBuy, Amazon only takes up about 2.23%. So that is the reason why it tracks more equally among other companies in this ETF. And for RTH, it's mainly about omni-channel operations, which have both physical and digital presence. So we see that other than Amazon, even though it's having a heavier weight in this ETF, we also see there's Home Depot, Costco, Walmart, Target. These companies are like, it sounds more like consumer staples rather than consumer discretionary. But the reason why they put in these companies within this RTH is because they have some exposure to the online sales. So that is the reason why they put it in, and also they are also under the retail industry. And from there, we will further investigate which company actually performed better than S&P 500. So we will share later. And of course, this is the thing that we are interested in. The past performance does not really reflect the future performance of this industry. So how will this industry go? Because no one will know that people will go to buy online, especially the slightly older generations. They prefer physical store because they can see the products, they can touch the products, and they will say that, oh, I'm too old, I'm not good at technology. But when COVID strikes, everyone has to go online because they cannot go to physical store to buy things. So this is something that we cannot foresee. But as human beings, we like to do prediction. So how far is this industry going to go? So in this future trend, we see that consumers are actually increasingly going online to shop rather than go to physical store, especially for the younger generations. And due to the COVID-19 pandemic, it has actually accelerated the shift from offline, that means from physical store to online, earlier by 5 years. So that it's kind of like pushing people more towards the online shopping. And here actually says that only 60% of the world population is online, but now people are having more usage of mobile phones and they have easier access to the internet. So it's actually creating a new kind of e-commerce market or a trend for the shopping. So here we explore what are the e-commerce trends, and we can see that technology is slowly shaping how we shop. That means it's changing our shopping experience. So first off, m-commerce is mobile commerce. That means they use their phone to go shopping. Like last time when we wanted to shop online, we usually use our laptop. But right now with the ease of mobile phone, everyone can go online with mobile phone. They can actually shop on their mobile phone. And another thing is omni-channel advertising. So whenever you try to go to a certain website to see something on the website, you wanted to buy, let's say, a bed, and then they will kind of like take note that, oh, you're interested in bed. When you go to your social media, they may have shown some advertisement that is related to bed because earlier on you have seen on it. Or you can go to, or you will go to, for example, some online marketplace like Amazon, and then they will show you something that you have searched before. That means it will kind of prompt you like, oh, you're interested in this. Are you like considering? And it will kind of send like kind of a reminder to tell you that, do you want to buy this? Yeah. So it's a shoppable video ad. So when you go social media online, the ads that you show, you can actually click on it and then buy things on social media. And also automated customer service through chatbots. This one is something like when we go to store, there's people to serve us, to answer our queries so that we can buy the things that we really need. But when you go online, there's no one to ask. So they make the ease of having a chatbot to help you to find what you need, to answer any of your queries. And AR. AR is augmented reality. So this one is something like Pokemon Go. I believe it's quite a hot topic last time where people use their phone and then they just show around and then they can catch cute Pokemons with Pokeballs. But that is what augmented reality. That means when you show your phone on to like using a camera to see, you can see the physical thing, but on your phone you can see the digital, the virtual thing appear on your screen, something like the Pokemon Go. So imagine you wanted to buy a sofa. You don't want to go to the physical store. So you can easily use your phone camera function and then you just show one corner of your room and then you can see the sofa and then you can see or imagine how the sofa will look if you wanted to purchase the sofa. So that is what augmented reality is. And finally, this is something that is quite interesting when I was doing the research. They have shopping assistant via smart home speakers. Like for example, Alexa. You can say, Alexa, I want to buy something. Then Alexa will show you something. Like I wanted to buy McDonald's. Then Alexa will say, oh, when do you want to have your McDonald's? So you can just use your voice and then buy things. So we can see that now they are moving forward to use technology to enhance our shopping experience online. So there is more to come. Okay, now we will deep dive into what are the companies within this industry. So first off, we will explore like what is e-commerce, what is online marketplace, and also what are omni-channels. So e-commerce is retail over online platform. So as long as there's transaction, buying, selling over online, it's considered e-commerce. And online marketplace is that there's transaction over a third-party platform. And omni-channels, this one is an integrated and personalized shopping experience. So what is it? Never mind, I'll share with you later. So for e-commerce, the difference between an e-commerce and also an online marketplace is that for e-commerce, they will provide you a platform, but you have to build your own website and you have to build your own brand. You have direct engagement or you can directly liaise with your customers and you're free to buy anything that you want. So as if that you open up a store, but not a physical one, but an online on the internet. So some of the platforms that they provide this service is Shopify or BigCommerce. So for online marketplace is that this platform, they provide everything for you. You just need to put in some settings and then you can easily set up your shop. So you don't have to build your own website. People can easily, like for example, Amazon, they provide this platform and people can easily go to Amazon and search for the things and then they can find your store. However, for this one, you may need to compete with other competitors that sell similar items, and you also may need to bid for the advertisement to show up top front. So if I wanted to buy a phone case, I just type iPhone phone case. Then it will show me a list of iPhone phone case. And that is the reason why for this one, you may need to compete with other competitors for pricing, or maybe whether do you show up at front when people are searching for it. So this is the difference between an e-commerce and also an online marketplace. So for omnichannels, this is quite a new term. So this one is that they retail all channels and all platforms and all devices. So if you say you wanted to buy a bed, so you go online and search for the bed, like let's say Sleep Joy. So you go to the website and see Sleep Joy. Then you think that maybe I'm not interested at the moment, but maybe some another time. And then when you're scrolling through your social media, the ad on the social media pops up, says that, oh, that's bad. It's because earlier on you've gone to the website to look for bed. Then they will prompt up like kind of a reminder, tell you that, oh, last time you saw a bed, are you interested to buy a bed? Maybe you say, maybe not at the moment. Then you go to Amazon and compare different beds online first before you do deep dive into your research. And then they will show up certain related ads about the bed. Then it's like, I'm interested in this, but how does it feel? So maybe you will go to the physical store to find out how the bed feels. So it's kind of like you can buy things from different channels and different devices. So this is what omnichannel is. So it's both offline and online, so you can purchase seamlessly between these two models. So some of the examples of the companies are like Walgreens, Sephora. Okay, so now we will look at the performance of online marketplaces. So these are the 4 companies that actually able to bid against the S&P 500. So the S&P 500 is actually blue color, and there's Amazon, Liquidity Services, Copart, and SC. So we see that SC actually performed really, really well during the pandemic. But then we are curious about how the other 3s are performing, so we zoom into this 3 and we see that, okay, both Copart and Amazon actually perform better than S&P 500 for the past 5 years, but Liquidity only performed quite well during 2021, and currently it's still above S&P 500. So we all know what is Amazon, so that one I will not explain, but what is Liquidity Services? It's actually an online auction marketplace. So what does it actually auction? It's actually a B2B e-commerce marketplace platform. So it actually provides a platform for businesses to sell their products, and they actually sell a lot of products. So when I was doing this, it's like, oh, really, really a lot, from hardware to many things. So it's more than 500 product categories. It's quite hard to simplify here, but it's just that it's a really, really big auction marketplace. And they also have different types of e-commerce marketplace for different product categories. And then next up is Copart. So Copart is another online auction marketplace for vehicles. So any vehicles that is being used, wholesale or repairable vehicles, will be sold on this platform. And then Etsy. So Etsy, what is it? It's actually a marketplace for vintage and craft goods. Because during COVID, everyone has to stay home. So they wanted to find some extra income. So maybe some people who are good with artworks, they maybe can do their own artworks, craft, and then they can put it online to sell. Okay, next we are exploring about omnichannels. So for here, omnichannels, when I was doing my research, I noticed that these are the companies that actually perform better than S&P 500, which is Home Depot, Costco, Lowe's, and also Target. So Home Depot is actually a home improvement retailer. So they sell building materials and home improvement products. Last time they have their own physical store, but because of COVID, they are slowly shifting their businesses online. So it's kind of a mixture between an online and offline. So they are moving forward towards omnichannels. And then Costco, warehouse retailer. So when I was looking at this, it looks more like consumer staples to me though, but since it's within the RTH ETF, so it's also considered like between a combination of an offline and online presence. And next is Lowe. Lowe is similar to Home Depot, which is also a home improvement retailer. And Target is a general merchandise retailer, so they sell a lot of things. It's kind of a big hypermarket. So we can see that right now in Singapore, FairPrice is also offering online purchase of groceries, and then they will send it to your home. So it's something like you can buy your groceries in a FairPrice store, or you can go online to purchase, and then they will send it to your home. Okay, so now we will look at these few companies. How do they actually perform? So for this one, it's actually a pre-screening, so it does not mean that it's a good to buy company. So we'll just have a quick glance to see which company can catch our interest. So these are the 8 companies that I listed out. So we will compare between their profitability, how is their cash flow, and also how is the company managing their debt. So for PE ratio, it's actually share price over earnings ratio. So it means that for the price that we pay per share, how much is the company is able to generate profits. So for this one, based on value investing methodology, as long as the company has below 16, it means that it's undervalued or it's cheap. So from here, I highlight out the companies that is below 16, which is Target, Lowe's, and also Liquidity Services. Next, we also look at net margin. So net margin actually refers to the percentage of profit that was being generated. So for here, I pick up the top 3, which is Etsy, Liquidity, and also Copart. And now for the cash flow part, we are using this ratio, the price to operating cash flow, which actually means that for the price that we paid per share, how much is the cash flow is being generated by the company. So for this one, if the ratio is lower, that means the company is cheaper to buy. So I pick up the lowest 3 of the company, which is Target, Liquidity, and also Lowe's. And then we are curious that how is the debt level of the company. So we are using debt to equity ratio. So based on value investing methodology, if the company has less than 0.5, that means the company is managing the debt well. So here I also highlighted out companies that has below 0.5, which is Liquidity, Copart, and also Costco. So from here, I tally up the points. So currently, the one that is leading is actually Liquidity Services. Okay. Next, we also compare about their competitive mode and also efficiency. So for competitive mode, we wanted to know that whether is there any advantage of the companies against their competitor. So we used ROIC, which is return on invested capital, and also WACC, weighted average cost of capital. So if we only look at the individual number between these 2 categories, it does not actually mean anything. It's only when we minus off return on invested capital, ROIC minus off WACC, then we get the difference. It only tells us that whether does the company has any moat. And if the difference is big, that means the company has certain type of moat. So from here, I pick up the top 3, which is Home Depot, Copart, and also Liquidity Services. Next up, we also look at efficiency. So efficiency means that how efficient is the company management uses the company's equity and also asset to generate returns. So ROE, if it's more than 15%, that means the company is able to use their equity efficiently. So here, ROA based on value investing methodology, if it's more than 7%, that means the company is able to use asset very efficiently to generate returns. Okay. So here we also tally up the points and then the subtotal from the earlier slides and we total up. So from here, we see that actually Liquidity Services is the first is running first, then followed by Copart, and also Target Group. Okay, so now we see, we have gone through this industry. It looks interesting, but is there any risk that we need to take note of? So first thing is that this industry is more sensitive to economic cycles because it's heavily influenced by consumer confidence. When the economy is bad, people will not want to spend a lot of money. So we can see early on the chart actually drops down quite sharply. But when the economy is good, then people will be happy to spend. They will say that, oh, this is something that I want. I have extra cash to spend on. So it rises up quite sharply. And also supply chain disruption also affects this industry. It's because when we see here, one of the news is that when there's increased consumer demand, but there's not enough supply because due to supply chain disruption, then the customer cannot buy the products and it will affect the businesses. And here we see that whenever there's a supply chain disruption, it actually affects the businesses because, let's say, for example, for Amazon sellers, they don't want to stock up too much because if they stock up too much of the inventory, they may need to pay a very costly storage fee. But if they don't have enough inventory and the customer cannot purchase, the customer might consider to purchase from another store and they end up losing the businesses. So they need to have a balance between how much inventory they need. So whenever there's a disruption in the supply chain, it will affect their businesses. And then next up, because this is internet and online, so we are heavily rely on internet. But if one day there's an internet access went down, how will it actually happen? First off, business will definitely be interrupted, especially online businesses, and the customer cannot buy things online. So actually, early on in July, Canada was actually hit by an internet outage. That means the internet network actually went down. So here they say that online shopping was closed because the internet cannot work at all. And also they also pointed out that since the internet cannot work and they cannot also accept debit or credit card payment, so if let's say the customer does not have a cash on hand, then they cannot purchase the product, which is very bad for businesses. Okay, so to conclude all, so whenever the economy is good, this industry will rise very sharply. And because right now people are using more online, going online using their mobile phone, so it may create a new type of e-commerce trend. However, something to take note is that this industry is very sensitive to economic cycles and it can be easily affected by supply chain disruptions. And whenever there's an internet outage, the influence is very severe. So with that, this is our short, our deep dive into this industry. So I hope that you have enjoyed this session. And with that, I'll pass back to Caden. Thank you.
It appears that we are doing some how should I say, like news broadcasting. News broadcasting. Then our teammate here, Irfan, was trying to twist the camera right, from left to right, right and left. It's okay lah. So that has nothing to do with our deep dive. But anyway, coming back to here, and there's another part which is quite interesting. When Hillary is talking about the outage, right? Yeah, outage, no electricity. I think recently, Malaysia, is it Malaysia? Is it KL, right? Is it KL got some shutting down of electricity? No, anybody can share? Is it KL? Is it KL recently got electricity outage, right? Yeah, I still remember when I was a kid. I mean, I'm 51 years old. When I say kid, right? That should be 40 years ago. So I stay in a one bedroom HDB flat in Bill Crescent, right? So that was 40 years ago. Now, just to let you know, 40 years ago, if you are still around, that means you are my age, right? Outage of electricity are quite common. Quite common. Every maybe 1 month, 2 months, there'll be like outage and so on. Yeah, but for children, I think it's quite fun. For children, is whenever there's an outage, we all rush to the corridor, right? Or corridor. Then we will take candles, because we know this thing is going to happen. So at home we stand by candles. So we take candles, and then like celebrating birthday, right? We take candles, we will burn, and then put it on the what do you call that? Like the what do you call that thing, right? But anyway, at the corridor there's a concrete slab, so you just put it on top. And then the interesting thing is all the kids will do it. All the kids will do it. So one block, right? If I'm standing one block, you see all the Christmas lighting, inverted commas, Christmas lighting. So it's quite fun. So for children, we actually look forward to the outage. We actually look forward. But for parents, wow, my goodness, jialat, cannot cook, then the refrigerator, the ice will melt, that kind of thing. But coming back to here, I think for 40 years, things has really changed drastically. After the dot-com bubble burst in 2001, I think there was like a slowing down period in terms of the internet, right? And then subsequently it booms. And of course, the pandemic has really accelerated this. So coming back to what Hillary has presented, wow, so there's one person really appreciate, 2%, Sora and Sai 1107. Yeah, very clear presentation. Now, if you pay attention to what Hillary has shared, you realize it's not as simple. From the top down, you want to zoom in. Actually, not so easy. But there's one part that's quite interesting. I just need my teammate to put it to the slide, right? Now, quick recap to transition from where Hillary has left off. So remember, we start off with the sectors, where there are 11 sectors in the S&P 500. We identify the sector, right, which has outperformed this, because ultimately, we don't want to share a sector that underperforms. Then within this consumer discretionary, there's so many industry, right? So we focus on this internet and direct marketing industry. Yeah, but of course, we didn't look at the performance of each industry, because that's really a lot of work. Yeah, so first thing is we agak-agak, right? This might be the one. And then we check what's the performance. So in other words, using the index of this internet and direct marketing retail industry, it outperforms the S&P 500 index. Then we further zoom in, right? It's like we filter, right? In the end, we end up with 3 companies where 2, right, I've never heard of. Yeah, so even though I'm a full-time investor, but there's so many companies. So you look at this, this is number 1, right? Isn't this interesting? Liquidity services. Oh my goodness, never heard about this. Okay, then the second one, right? Copart. Wow, never heard about this. So as value investors, we want to look at something that people are not looking at. Then the price tend to be cheap. Okay, price tend to be cheap. Then this one, right? Of course, Target, everybody would. Yeah, Target is quite common at Amazon, Target. Whenever companies that people talk about, usually we want to shun because price tends to be high, right? Home Depot. Yeah, this is also not so common. Yeah, so I think what I will do on my sideline, right? Since Hillary already done, like most of the work, So on a personal side, like outside my company, what I'll be interested in is I'll be very interested in this company called Liquidity Services and Copart. Yeah, I want to know what do they exactly do, how's the performance and so on. Yeah, so which means that from the top, sector, filter, right? Then in real life as an investor, we will zoom in and see whether these 2 companies are investable. Yeah, so remember the first one of the criteria is we want it to beat S&P 500. Yeah, because the return is about 10%, right? So there's no point for me to buy something that is less than 10. Yeah, so if these 2 are good company, performance has a beaten S&P 500, I think something worth putting my money in. Okay, so in real life, right, I'll be interested in this Liquidity Services and Copart. And then just now, when Hillary was talking, when Hillary is talking, I'm paying attention. I'm a good student, right? So when Hillary was talking, there was one part where she talked about online auction. Yeah, online auction. Now, I'm not very sure how many of you are age 50 and above and have Casey Moon. Yes, they have blackout. Blackout fund, put candle, right? Yeah, so during my time, let me see, let me travel back in time. Right? The dot-com bubble burst in 2001. So what I did was I did a master's, I did a master degree, right, of e-commerce, NUS Quite e-business in 1999. Yeah, 1999. So in 1999, right, there were 2 online so-called internet companies that were popular. But remember, right, in 1999 was just the beginning of internet. Yeah, people just like 6:30 don't know internet, and there was no Facebook, I don't think there's even Friendster, MySpace, don't have. Yeah, but during the era, 1999, there were already eBay. Okay, then there's another one which is called a reverse auction marketplace, which is called Priceline. I'm not very sure Priceline is still around or not. Yeah, so can you imagine a Priceline, if they're around, they've been around for 20 plus years, and they have survived the .com. And the one that survived .com includes Amazon. Now, by the way, just to let you know that I'm just guessing. I think maybe 90% plus minus companies will perish. So Amazon's still around. And then right now, we've got a new company, Liquidity Services. Very interesting. I think I'm quite lucky to be healthy enough to live through, right, this period, the Y2K, the millennium, the dot-com bubble, the global financial crisis, to have witnessed how the world has changed. So coming back to here, I'll be interested here, check. Interested here, check. And then, remember, right, in the very beginning of this deep dive, we talk about one approach to find companies to invest. Yeah, some people like to take the top-down approach. Okay, which are the companies that maybe that will do well during the economy? Then we identify 11 sectors. Out of the sectors, consumer, discretionary, and then after that we zoom in, right, to the industry, right? And the industry will be the internet and retail. Okay, so from top you filter all the way down. Until just now, remember we got 2 companies, right? Copart. What's the other one? Liquidity. So maybe I just remember this word liquid. Yeah, liquidity. Okay, huh? So that's how we can filter business from top down. But I just want to highlight to you, that unless you are doing this as a full-time job, I think it's quite difficult for you to top down, right? Because a lot of time need to be put in. So that's one. Yeah, but if you want to spend lesser time, right, DIY, you do the bottom up. Okay, ladies and gentlemen, welcome back. Now, if you look at my slide over here, you will notice that there is this beach chair over here, facing the ocean and so on. And I like such photos. I'm quite sure all of us like such photos, right? But in order for us to be here, enjoying the day, regardless of whether recession or not, it's very important for us to have some form of assets that generate income, right? That's all weather, right? And just now during the registration break, I managed to find more news. I think as time passes, similar news is going to pop up. Yep, this one is the news is from The Guardian, right? U.S. economy shrinks in the second quarter, signaling an unofficial start of a recession. So I'm not very sure what's official and unofficial, right? Maybe Biden need to announce then it's called official. Yeah. So remember, 2 consecutive quarter for the GDP, right? It's a technical recession. Okay. So whether official or not official is okay. So let me just continue talking about the company that I'm going to share with you, right? But before that, this is a very quick photo of my investment journey. Yeah, and right now, why I'm very excited about a bear market recession, right? Because number one, it doesn't happen all the time. The second thing is, if it happens and if you do nothing, that's it. Don't talk about it. Okay, So if you look at this picture over here, this illustrates my wealth journey. It's like climbing up a very steep, treacherous mountain, right? And by the way, just to let you know that I got started investing, or rather, I was gambling when I was age 24. That was way in 1995 lah. That of course reveal my age. Right now I'm 51, right? 2022. Now let me share with you what I've gone through. I use army as a like a metaphor, right? You see, in order for a recruit to become a Rambo, right? Rambo, a lot of scars, a lot of scars, right? Then if you wear a trench coat, a lot of bullet holes. So the first crisis that I've experienced, so-called as a gambler, right? In the early days, I couldn't differentiate what is investing in gambling. But that was the 1997 Asian economic crisis. So that was the first crisis that I have so-called encountered in my life. But I was young. I don't really feel much impact, right? So, I don't know what's going on, right? But the one that I felt most impact is the second one in my life, which is when the dot-com bubble burst. That's when I lost all my money. And then my story appeared on the papers. Yep. So before this dot-com, right, from here to here, I was a gambler or a speculator. I was doing day trade, in short, believing I was investing. So if I lose money here and I lost money here, right, I think I deserve it. Right? So from 01 to right now, 2022, right, just to let you know that it's been a long 21 years. And during this 21 years, there's only one recession. There's only one, which is this global financial crisis. There's another one which happens in 2020, but because it's so short-lived, nobody even feel that there's a recession. Yeah, but these are really the big one, right? So the reason why I want to show you this diagram is I've been through all these 3. Walter Storch has been through, I think, 47 recession. But I've just been through 3, right? But these 3 recession has taught me one very important thing, is when a bear market or recession comes, share price will fall. Yeah, for sure. How low it goes, usually for a big crisis, the S&P 500 falls about 50% for its recent high. Bear market is only 20%. So I've been waiting for this day for a very long time. Yeah, since 2008, which is 14 years ago. Now, which means that right now, finally, I got another one shot. Yeah, I mean, I don't think I can wait for another recession. I'll be 60 plus. I'm too old already. So now is the time. Now is the time, which goes back to this news, right? Now is the time. So at from my perspective, I already have a list of companies in which I share with you, 40 over companies. Out of these 40, I can cherry pick which are the companies that I really like, tapping on the shoulders of our list of authors who are partners of our VIA, right? Value Investing Academy, right? Yeah. So I just want to introduce to you one company that's found inside this database. Okay, Now remember, as value investors, we take the bottom-up approach. From bottom, it goes up. Yeah, bottom up, it goes up. So the company, just to let you know, right, the company is a US home builder. It builds home. Builds home, right? Yeah, builds home. So whether recession, not recession, I think you need a home. Yeah, maybe the home building may slow down, but you need a home. Yeah, so in the very beginning, I assume that things should be okay, but we need to deep dive, right? Deep dive, huh? Now, so let's look at the revenue, and I'm going to go really slow over here because if you become a subscribers to the case study, right, the author is going to explain to you this company, what is it, but I'm going to skip that part, otherwise it's going to take very long, huh? Now, revenue, everybody will know, if the companies make money, it's known as revenue, right? And from the value investing perspective, we want the revenue, right, to get higher, higher. The company is doing better and better. So in this case, it's a pass, right? Yeah, from the angle of value investing. Yeah. So we want predictability. Okay, so for the past 10 years, it's predictable. Now, next one, we want to look at something called a net income. Now, net income in short is the profit or loss. So if we take revenue, right, minus all the expenses, we have had something called profit or loss. And sometimes profit and loss is also called net income. Yeah. So you can see this is a zero line over here, right? Yeah. So overall stable, and then choom, it goes up. So again, we want predictable profits because predictable profits, predictable share price. So in this case, value investing perspective is a pass. Now, then we also want to look at something called the net margin. So what do you mean by net margin, right? You can see this number 13.98 over here. Let me just round up to 14 so that it's easy for me to speak. So in net margin equals to 14%. What does it mean? That means for every $100 of revenue or sales that they make, yeah, minus all the expenses that they have, right, $14 is left. Now, just to let you know that anything above 10 is already above average. Like Walmart is about, I think, 4 or 5%, right? So 40% is pretty good. So you realize that for years, you know, they're quite stable, and then there's a gentle upslope. Now, remember, it's not easy. I'm running a very small firm, right? To have a net margin being consistent and going up is very difficult. Yeah, even my company, net margin, I don't think it looks like this. Yeah, it's very difficult. It's very difficult because you have to compete with competitors, right? And then maintain your margin, which is very difficult. So what does this mean, right? This means that the company has great management. They manage the company so well that it could maintain the margin, yeah, at 14%. Yeah, so based on the angle of value investing, is a pass. Now, the next one, we look at something called cash flow from operation. So what does this mean, right? So if let's say I run a cafe and I sell a cup of coffee, yeah. So when I sell a cup of coffee, cash comes in, right? I put it in my cash register, right? I sell noodles, cash comes in, right? So the cash that I make from selling things a day to day, right, are the cash flow. Yeah. So for example, Teo Heng, which is a KTV, right? During the pandemic, 2 years cannot sing, Yeah. The cash, instead of going in, they go out. Yeah. So we are looking at companies where it's coming in. Yeah, rain or shine, right? So you may notice from 2016 to 2022 onwards, yeah, it's a uptrend, right? So now cash is coming in. Not it's coming in, it's coming in more and more over the years. Yeah, by building homes for people. So it's a meaningful company, right? So based on value investing philosophy, right, it is a pass. Then we have something called a free cash flow. How come the cash flow is free, right? What does this mean? Now, it simply means that if I take this money from selling noodles, from selling coffee, which is the cash flow, right, from operation. So remember, I sell coffee, so I take the cash, right? And I take this cash to buy equipment, buy a coffee making machine, buy chairs, buy tables, right? And all these items that will last more than 12 months are known as capital expenditure or CapEx for short. So I want you to imagine that you sell coffee, you take cash, buy equipment or whatever, still got cash left. No? And this cash is freely available for you to use, right? That's why it's called free cash flow. And of course, we want money to be left, right? So not only here, can you see more and money after paying for capital expenditure, more and more money, what am I saying? Tongue tight, right? Yeah, so as long as the uptrend, positive, yeah, is a pass from the angle of value investing. So pass so far, yeah. So just to let you know, before I carry on, these are the companies that we allocate within our subscription. Right? So we go through all the work, not because I feel like it. No. Now, then let's look at the efficiency of the companies making money. So there's this thing called ROE, which stands for return on equity. Yeah. And then return on asset. This one we want to be more than 15%, right? Yeah. So can you see here? It's more than 20. It's 27, right? So obviously more than here. Pass. ROA, right? We want to be more than 7. Here's 15, right? Yeah, 1.7, pass. So far so good, Sweet, right? Remember, that's the kind of companies that I want. Yeah, so I'm just sharing with you, right, via the case study subscription, right? And of course, the company can make a lot of money, but you know, when you take the money you put inside the pocket, and if the hole is too big, right, yeah, eventually you end up with no money in the pocket. So these holes, right, as a metaphor, is actually the debt. I don't think anyone want to owe people a lot of debt, right? Yeah. So you want this to be less than 0.5. So you may notice there's a declining trend, right? Yeah, so their debt is getting lesser and lesser until at this point it's less than 0.5, right? So again, it's a pass. So you realize that over the past 10 years, things are better and better. And it's quite predictable, It's not cyclical, right? It's predictable, Now, since today's topic, we're talking about recession-proof, right? So is this company recession-proof? Now, if you look at this graph, what does this mean, right? This gray line represents the company's profit per share, or sometimes called earnings per share. So in other words, you buy one share of the company, how much profit is the company making? So of course, over the long run, we want it to go up, But because I put this over a long period of time, right? If there is a going up, right, it's not so obvious, because it's stretched out, Yeah, but the intention of this diagram, right, is to show you, is this recession-proof? Now, there are 4 gray zones over here, right? Yeah, so we wanted to know, if the gray zone appear, did the profit go up or come down? So the first gray zone, which is known as the 1979 energy crisis. Yeah, so here, energy crisis proof. Check. This one, right? 1990 oil price shock. This is the name of the crisis. So still okay, right? Not that bad, So check. Yeah, so-called bulletproof to recession. This one, right? Dot-com bubble burst. Well, in fact, it goes up. I mean, dot-com bubble burst, not a housing bubble, right? So you see, it goes up. Yeah, check. But this is serious. Yeah, this is the global financial crisis, right? Yeah, so can you see here? It goes from here to here. You know, the profit drops, right? Yeah. So if the company has great management and the company is really good, right? Do you notice that it climbs back up? So 1 year, really strong drop. It takes quite a number of years to pick up, But do you notice once it picks up, can you see? It makes more money, right? And you look at the peak to peak, we compare to peak to peak, can you see? Makes higher, right? But it takes time, right? You must give the company time. Yeah. So here, oddball, don't count. But let's say we join here to here, right? And then after that here, which is the pandemic, right? The COVID crisis, still goes up, right? Yeah. So out of the past, I think 20 plus years, 1, 2, 3, 4, 5, right? 5 crises, they survived 4. In fact, the global financial crisis, they also survived. Yeah. So to me, this is quite recession-proof. Quite recession-proof. Now, if they can survive .com, I think this crisis, I don't think there's an issue. Now, but the best part is this. The best part is this blue line, right? Oh, both looks blue. Okay, this line is the profit, earnings per share. Earnings per share, you see it's uptrend, right? Uptrend, right? Yeah. So this earnings per share is also the company's value. How valuable it is. So you may notice when this line goes up, right, the company becomes more and more valuable. In other words, internal KPI, right, is going the right direction. Right direction. Now, so what's the opportunity for us? Do you realize that the price is going the wrong direction? Wrong direction, right? Yeah. Then there is a gap between here and here, right? It's like a Rolex watch that is valued at 10K, right? But right now it's selling you at 8K. You know what I mean? Yeah. So if economists, media reconfirm that just now what we have shared is really the unofficial recession become official, right? Then the price will fall further, while the internal KPI is going the right direction. Yeah. So that allow us to buy a $10,000 Rolex watch at 8,000. Yeah. So the heavier the recession fall, right, the cheaper it is. The 8 may go to 7. 7 will go to 6. 6 may go to 5. Yeah. So this is our opportunity, provided you know what to buy, in which our US case study subscription will serve. But that's not the end, this company, right, is in our case study. Case study, right? Remember, myself and Hillary, as well as a team of 3 people who are supporting all of you tonight. So total, we have 5 people, right? So remember, we are from VIA, Value Investing Academy, and our mission, right, is we care to make you a better investor. Okay. So I shall see all of you soon, including Angeline and Vietnam Beauties. Okay, goodbye. Thank you.